By early 2026, the precious metals market delivered severe whiplash. Silver crashed from its high of $121 an ounce down to below $79, while gold retreated from its $4,800 peak. We are going to replace that emotional guessing with a reliable tool. Together, we'll build a 4-quadrant precious metals evaluation matrix. Take a moment to grab a physical pen and paper or open a digital notepad. I want you to actively sketch this framework out step by step. Daily headlines are often designed to trigger reaction rather than reflection. A data-driven, personalized checklist forces you to evaluate entry points based on actual market mechanics. Title the first section of your matrix Macro Risks. Here, we are specifically looking at the US dollar index, the DXY, and Treasury yields. It is a mistake to assume that geopolitical conflict guarantees a rise in precious metals. The actual relationship is dictated by how that conflict filters through the bond market. Look at the 2026 crisis near Iran. The immediate threat was to the Strait of Hormuz, causing severe shipping disruptions, which then spiked global oil prices. Sustained high oil prices feed directly into higher inflation. To combat that inflation, the Federal Reserve is forced to keep interest rates and Treasury yields high. This chart shows the inverse correlation in real time. As Brent crude and Treasury yields move up on this axis, we see the downward trajectory of silver, dragged down because it pays no interest. Write down your first checkpoint rule in quadrant 1. Rising yields mean high macro risk. Falling yields mean low macro risk. The fear generated by geopolitical headlines eventually fades, but the macroeconomic gravity of bond yields controls the price trend. Let's move to the second section of your page. Label this Industrial Fundamentals. We are shifting our focus away from financial speculation and looking at the physical reality of the metal. This chart demonstrates a growing structural deficit. It shows 6 consecutive years of negative supply, with the shortfall reaching 46.3 million ounces in 2026. The primary catalyst driving this shortage is the global energy transition. In March alone, China imported roughly 836 tons of silver, a volume required for solar panel manufacturing. In your matrix, you have to weigh this aggressive, continuous technological demand against a physical supply chain dealing with global mine depletion and aging infrastructure. Financial panic comes and goes, but industrial consumption permanently destroys supply. That creates a hard physical floor for future prices. Create your third section and title it Who is Buying? For this step, we are looking past retail sentiment and jewelry demand to see where the heaviest capital is moving. While everyday consumers often hesitate when prices fluctuate, central banks in China and Turkey, along with industrial powers like India, have been executing multi-billion-dollar accumulations. Now, draw a final section at the very bottom of your page. Label it The Verdict. This is where your evaluation comes together. Here is the scoring logic. If macro risks are pushing prices down temporarily, but you confirm that industrial deficits and institutional buying remain massive, you have a high-value entry point. Conversely, if macro risks are low and prices are soaring, but industrial demand begins to halt, the verdict shifts to a hold or sell position. The framework functions by identifying that specific gap, where the noise of a terrifying news cycle is directly contradicted by the quiet, multi-billion-dollar accumulation of global powers. Look at the completed matrix in front of you. You have successfully translated a chaotic sea of global news into a single, logical framework. This tool insulates you from emotional trading. It forces you to check solar manufacturing demand, central bank fault holdings, and bond yields. Right now, pull up the current charts for silver and the DXY. Apply your new matrix to today's data and see your verdict. In commodity markets, the traders who react to headlines become the liquidity for the investors who follow the fundamentals.